The broadcast is now starting. All attendees are in listen-only mode.
Hello, good morning, good afternoon, good evening, depending where you are in the world. Welcome to the webinar on evolution of corporate ESG engagement strategy. I am Mustafa Chowdhury, Senior Producer at Climate Action. Thank you so much for joining us. It's a pleasure to welcome so many listeners to today's webinar. We've received over 700 registrations, and that's a testament to the excellent speakers who are participating and sharing their thoughts on and experiences on this really important topic. Please be aware that this session is being recorded, and a link will be emailed to you shortly after the webinar is complete, so you will be able to listen to it again and share it with your peers. Before we start the webinar, I'd like to give you a quick introduction to Climate Action. We were established 10 years ago, and we are a global media and events platform, and we build partnerships between businesses, government, investors, financial services industry, and public bodies to accelerate international sustainable development and advance the green economy. Today's webinar takes place ahead of the Sustainable Investment Forum North America, one of the leading multi-stakeholder events focused on sustainable investment. We've engaged with key asset owners, asset managers, banks, regulators, policymakers, NGOs and think tanks to drive sustainable investment and collaboration between all stakeholders. The forum is held in official partnership with UNEP-FI, and it's the perfect place to meet, network and share ideas and discuss concrete solutions to current challenges of global climate finance market. Speakers for this year include Betty Yee, Controller California, Pete Granis, Deputy Controller, State of New York, and lots of others. Please visit the website for more information. This brings me to today's webinar on evolution of corporate ESG engagement strategy. A growing number of investors are undertaking corporate engagement and exercising their rights as shareholders to influence corporate behavior. The commitment made by CA 100 plus investor signatories includes the use of their voting power to demand and secure corporate action to curb emissions. In filing and voting for climate-related resolutions over the last several years, institutional investors have already shown themselves willing to challenge the boards and management of high carbon companies when appropriate and necessary. I feel extremely privileged to welcome three excellent speakers with significant experience to address this topic. I would like to welcome Adam Matthews, Director of Ethics and Engagement, Church of England Pensions Board, and he's also co-chair of the Transition Pathway Initiative. We've got Catherine Howarth, she's Chief Executive of ShareAction, and we've got Lisa Beauvilain, she's Head of Sustainability and ESG at Impax Asset Management. Each speaker will take a few minutes to present their views, following which we will take questions from our listeners. You can submit your questions via Twitter using the hashtag SINVNA or using the question box on the GoToWebinar bar on the right of your screen. Don't be shy, we'll try and get through as many relevant questions as possible in the hour time frame. And with that, I shall hand over to our first speaker, Adam Matthews. Adam, are you there?
Hello, thank you. Excellent. Well, thanks very much for inviting me to join the panel, and really looking forward to the conversation. So, really what I thought I'd do in terms of answering the question and just trying to find out how to navigate between slides. Okay. It's really looking at the trends in engagement related to climate change. And I mean, I see 5 key trends at the moment. And what I'll do is briefly sort of outline those. And then I'm going to sort of deep dive a bit into the kind of tools we're using to guide our approach to engagement, and then pick up again on some of the points that I'm sort of outlining here. So in first, my first trend I really feel that is clear is that, I mean, I think asset owners are becoming a lot more organised. You've got the Climate Action 100, which you're seeing a sort of unprecedented level of coordination between investor networks in a way that we haven't had before. And you've now got $30 trillion behind of assets under management behind this initiative. And as a result of that, you're also seeing a greater allocation of resource to that kind of approach. We, the Church of England Pensions Board, we're a relatively small asset owner, but we have also signed up to this. We represent ESG beneficiaries, very much view this as a key issue for us in terms of delivering them a pension fund, but also a world in which they can retire into. So we're very happy to support the objectives of Climate Action 100. The second trend I think you're seeing is asset owners are really beginning to sort of outline their expectations. Often asset owners are resource poor. Often they have far less resources than fund managers, and therefore are sort of not in the same way able to sort of engage in engagement programs or express their sort of perspectives on issues, perhaps to the same effect that better resourced organisations can. But I think you're beginning to see a sort of change in that. Obviously, you have organisations such as the MPRI and the investor networks where asset owners have a clear sort of position in the sort of primary respect. But at the same time, I think you're seeing asset owners through initiatives such as the Transition Pathway Initiative coming together, recognising that there is a gap here in terms of the expectations that asset owners are articulating, and creating innovative tools to be able to find ways that they can actually articulate their expectations of companies in the engagement that they're expecting to have with them. The sort of third trend really is, I think you're seeing a great willingness to use different engagement tools. I think we all have the tools available to us that we really need to drive change. It's just a question of how we wish to use them, and to what degree you're able to garner greater support amongst people than acting in silos and by yourself. So, and I think you've seen some interesting trends this year where you've had the shareholder resolution filed at Rio Tinto on corporate climate lobbying, and you had 20% was voting against management on that, despite very strong management opposition, and also voting proxy voting advisors advising against supporting the resolution. I think you're beginning to see asset owners, along with other actors, being able to sort of step up and actually press companies on issues. And I suspect that you'll see this as a growing trend over the coming years. But hopefully this will be something that will be merged much more into the globalized engagement platforms such as CA100. One of the most important trends, and I think really we are at this sort of a key point in engagement, is the sort of transition from really engaging for the purpose of gaining more disclosure to actually engaging on performance, and whether companies are actually doing enough and that meets expectations of asset owners, funds, etc. And I think there's been a very heavy focus on disclosure. I think that's been very necessary. There's been shareholder resolutions seeking that disclosure from companies, but disclosure doesn't necessarily correlate with actual change in company corporate behaviour. And I think you've seen a real shift, particularly over the past sort of 6 months, where there's now a greater focus. Actually, it's about targets. It's about whether a company's ambition is sufficient, if it's aligned with below 2 degrees, etc. And I think that's a very important move at the moment. And then the last trend, I think, is that I think you're beginning to see real signs that we're entering transition. I think it's something we've got to be careful about calling, but at the same time, I think there are signs out there that engagement is beginning to show impacts. You're seeing companies that are moving totally out of coal. You're seeing other coal companies saying that they intend to make no further investments in this. You're seeing the likes of Shell and Total breaking ranks with their sector and setting ambitions to reduce all of their emissions across all the risk So I think you're seeing quite a sort of important moment. I think it's the beginning of the transition and the beginning of the very detailed dialogue that we need to have in engagement. So I'm just going to quickly dive into, over the next few minutes, one of the tools that a group of asset owners we included felt was necessary to create, was the Transition Pathway Initiative. We felt there was a lot of information out there. There was a lot of good company reporting, but in effect we've been absolutely swamped with a great deal of detailed information. But was it actually what we needed to be able to make informed judgments and to drive engagement and also to help inform our decision making in relation to our funds? And so the TPI was established as an effort of a group of asset owners globally. These are the partners that we formed with an academic institution at LSE, FTSE Russell Data, and with the support of PRI. And we've now grown up to 7 trillion of funds are now behind the initiative. And really, TPI seeks to do two things. And this slide here is just of one of the assessments. We've assessed 138 companies to date. And that really gives us a sense of how companies are positioned, first in relation to their management capacity, which is the blue staircase. Here it gives you a real sense of where companies are in terms of whether they're acknowledging it as an issue, whether they're not acknowledging climate change as an issue, which is a level 0 company, ranging up to level 4, which is a company that's really grappling with climate change as a strategic board level issue. And so for me, it's absolutely essential I have a tool as an asset owner, as someone that engages, that can identify which companies have those capacities, where are those weaknesses. But this is something that I've identified with other funds as the kind of areas that we need to gain assurance around. On the other side, you've got the key contribution, I think, of the London School of Economics, which is to understand how companies are positioned for the transition, and in particular, whether they're aligned with 2 degrees or not. And it's traffic lighted, so what you see in this sector is a clear number of companies actually have fleet efficiency standards that actually mean that they are aligned with a 2 degree scenario. But come 2020, very much these targets fall off a cliff. So I think there's a clear area in terms of need to focus, but also very clearly this identifies to me those companies that have got very unaligned forward targets as they stand. The anomaly in this sector, in case anyone asks, is Tesla. They clearly are by far the most efficient in terms of looking at alignment to 2 degrees, but at the same time they're one of the worst in terms of actually making public disclosure in terms of how they manage climate change as a company. And TPI is a tool that's based purely on public disclosure. We don't use third-party data sources. It's company disclosure, and in this regard Tesla actually do not disclose any of the criteria that we've set out that we feel we need to understand. So there is an anomaly in that one, but overall I think this gives a very clear assessment of how to approach this sector. But here, as I say, we've covered 138 companies across 7 sectors, and as of Monday next week we'll be releasing another assessment of 105 companies, which deepens our assessment in the oil and gas sector, in the electric utility sector, and in mining, which will take TP up to about 180 companies covered. And by the end of this year, this should be covering about 230. Next year, we should be up to around the 400 companies covered, which really should cover the vast majority of the major companies that are have a clear relationship with the transition. And this slide, in effect, shows where companies are currently positioned in management quality. And again, in terms of the disclosure, I say it's been very important, all this emphasis on disclosure. There still is a need for more disclosure from companies. A lot of companies across the 138 that we've assessed to date still have a great deal to go in this, but at the same time, it does give us a clear sense of where to focus efforts. But the most important thing, as I say, disclosure is important, but actually the relationship with performance. And here we really do need to do a great deal more engagement. And I think, as I say, I think we're at this sort of key inflection point almost, where you're beginning to see companies making very important strategic moves, starting to disclose against ambitions against 2 degrees. And I would hope in time that these kind of donuts that currently show the limits of disclosure will actually will change quite considerably. And then the last sector, really, again, I just wanted to sort of connect to that sort of point around disclosure to performance to companies, sort of changing their approach. Here you've got TPI's first assessment of 3 oil and gas companies, and these are the only 3 that TPI can do based on current disclosure. And it very much came as a result of Shell coming out with an ambition that covers all of their scope emissions. This is against a benchmark of 2 degrees and the grey dotted line, which is the commitments of governments, the NDCs. And you've actually got Shell setting a forward ambition to actually reduce across all of their emissions, and that means we can actually measure this. And that does change the discussion. We now move from a discussion with Shell about arguing whether they should have such an ambition or not, to actually one where you can now decide whether that's sufficient or not. And so most oil and gas companies still do not provide sufficient disclosure to enable us to look at all of them across this in this way. But as a result of this paper, we've been getting a lot of feedback from the sector, and my expectation is that a trend will be that you'll see more disclosure from oil and gas companies into a metric like this that enables us as asset owners to understand where they stand in the transition. And also that means that the discussion moves on. So it moves to performance. It means that we now have a discussion, and as I mentioned, one of the trends is it goes into whether these kind of approaches are ones that the company are deploying, and we can make judgments in our engagement and in our discussions with them about whether they're realistic, whether they meet our expectations. And I think it really does change the dynamic of engagement. And I think this is a trend you will see coming forward in the coming years. And then the last point, really, I think this does go hand in hand with engagement, is really to ensure that it also is contributing to investment decision making. And TPI as a tool is there to support engagement. It's something that asset owners are using, are integrating into the way that they're voting and into the way that they're focusing their efforts. But at the same time, it's also something that funds are increasingly starting to use in terms of how they could potentially look at decarbonising their portfolio. This is something the Church of England Pensions Board is exploring at the moment, and it's something where once we've got a full understanding of such sectors such as oil and gas and mining, we will feel we'll be able to sort of more proactively use such a tool in this kind of way. And then really my last slide is the obligatory disclaimer that I have to display. So thank you very much. Happy to take any questions later on.
Thank you so much, Adam. I follow Adam on Twitter. It's certainly been very, very interesting looking at you attending different AGMs this year and different things that you've done. So thank you very much, Adam. So I would like to remind everyone that you can submit your questions via the platform, and also if you use the hashtag SINVNA on Twitter, we are also picking up those questions. Now I would like to introduce Catherine. Catherine is Chief Executive of ShareAction. Catherine, I am handing over to you now.
Okay, great. Well, hello everyone. I'm just going to see if I can move my slide along. I might have to ask you, Mustafa, to move my slides along. Oh, there we go. Something's come up. Great. So I'm just going to give a little bit of a kind of a very high-level overview of what I feel is happening in terms of the evolution of corporate engagement, because I think it's a field where things are moving quite fast. There's a lot of techniques and ambition emerging from both asset owners and asset managers. It's actually a very lively scene. And if you just move to my next slide. Thank you. Just a tiny bit of context. Obviously, you know, millions of people across the world are members of pension schemes, and they have their own personal savings plans and all the rest of it. And this money is channeled into the capital markets, which is an incredibly important leverage point for shaping our world. And I think there's more and more public recognition and policymaker recognition that what goes on in the investment industry in terms of how the interactions that take place with companies, the capital allocation decisions that are made, is kind of critical to whether we will, for example, achieve the goals of the Paris Agreement, but in many other ways shaping our future at this kind of critical moment in terms of all the challenges around resource allocation and so on. So I just want to give a sense of just how much the decisions made by professional investors and particularly the engagement strategies with companies is increasingly understood to be an enormously important lever for shaping and changing the world. And I think the two key things are both the capital allocation and the stewardship of assets, in other words, engagement. So if we move on to the next slide, which is just around the fact that this is embedded in the PRI principle too. Everyone will be very well aware of the PRI, which over the last 12 years has grown enormously. In fact, yesterday I understood they celebrated 2,000 signatories, and the majority of assets under management, institutional assets under management in the world, are actually signed up to these principles. The second principle is we will be active owners and incorporate ESG issues into our ownership policies and practices. So you've got 20 trillion of assets under management around the world committed to principle 2. But I think when you look back over the last 10 years, you know, the level and kind of quality of engagement practices has been shifting quite fast, and we're also now seeing this at a policy level, less so in the States, I think, but very much in the UK and in Europe. Stewardship, which is this kind of catch-all, perhaps quite jargony European phrase for the engagement that takes place using the vote and dialogue, direct dialogue between investors and companies. That is, you know, now a real priority for policymakers, and they're recognizing that, for example, in Europe, it's now considered, you know, part of a trustee's fiduciary duties to have a stewardship policy, to have an engagement strategy, to be ensuring that your asset managers are doing this. So it's kind of moved from being kind of a bit on the edge and a bit something that a few kind of progressive investors used to feel was a good thing to do, and certainly made an impact through doing, to now being something that's kind of everybody's game. So the next slide is just highlighting a few examples of some of the kind of collaborative engagement initiatives that are underway. And Adam has already talked about some of the very interesting engagements that he's involved in, and Adam and I work closely on some of these things. But I just think it's worth saying that, in a way, CDP, Carbon Disclosure Project, was probably, you know, the first really important example of a collaboration where investors came together to demand, through an engagement process, which was the CDP letters every year, that they want, you know, climate relevant data from companies. And CDP has kind of paved the way for all sorts of other things that are now going on in the space. So I just wanted to highlight a couple of other examples. So Workforce Disclosure Initiative, which is actually something that ShareAction is coordinating, is almost like a mirror image of CDP, but instead of focused on climate data, it's focused on companies' disclosures around how they manage people, both in their own operations and in their supply chains. And it's just a nice example of how what's moved from being just more of a climate and environmental story is now a practice that's covering all of E, S, and G. And actually, I would say, in terms of the evolution of these things, I think the S of ESG is actually really coming up the track, and a lot of investors very interested in it. Turning back to more the climate side, another engagement initiative that we are involved in coordinating is something called the Investor Decarbonisation Initiative. And there are 64 investors from all across the world, from 5 or 6 different continents across the world, signed up to this. And this is a request to companies to set science-based targets. So this is a real engagement focused on pretty tough and ambitious action commitments by companies to align their business models and ultimately their supply chains as well with the decarbonisation goals of the Paris Climate Agreement. So whilst Adam referred to a lot of engagement focusing on corporate disclosures, it's important to be aware that there are some quite ambitious engagement and collaborative engagement activities going on which are demanding action from companies. And the good news is that a large number of publicly listed blue chip companies have now committed to science-based targets, to very ambitious goal setting on decarbonisation. Some of that's around committing to 100% renewable electric power in their operations across the world. Companies that have committed to that, thanks to investor engagement, include Tesco, Vodafone, AB InBev, which is the largest drinks and brewing company in the world. So you've got some very big names where there's very strong evidence that corporate decisions to be ambitious on decarbonisation were very much nudged along by investor engagement, by coordinated letter writing, meetings, AGM questions, the whole sort of suite of activities that involves investors using their influence with companies. So I just want to emphasize this stuff does work, that investor engagement really does add value in terms of what companies end up doing. And I think it's a very, very important part of how institutional investors demonstrate that they're delivering value to their clients and beneficiaries, that this kind of engagement activity is increasingly what is expected of good investment organizations. So I won't go into too much detail on Collaborative for the Living Wage. It's another one which has had a huge amount of success getting companies to commit to being credited as living wage employers, thanks to a lot of investor engagement. But then the final point, and again, Adam's covered a bit of this, but shareholder resolutions are on this super interesting journey where resolutions which, a few years ago were considered, especially in Europe, a very sort of aggressive strategy, have now been normalized, and there's an expectation that it's perfectly normal and okay for shareholders to file these resolutions seeking from companies. Well, it started very much around disclosure. We as the shareholders want to have a better understanding, we want stronger disclosures from you as a company about how you're considering, for example, climate related risk. And we're moving now, we've seen this just in this recent AGM season, to resolutions that are a bit more directive and based on investors, I think, really claiming a sense of agency over handling how they manage climate risk in their portfolios through resolutions. And Adam referred to a couple, very, very interesting at Rio Tinto, this lobbying resolution which got a lot of support. It got 20% of the shareholders voted against management's recommendation in support of this resolution. And that will undoubtedly change board thinking at Rio Tinto on its lobbying practices. And similarly, the very interesting resolution that a number of us were involved with at Royal Dutch Shell, which called on the company to set targets and then publish and then apply targets that align the company with the goals of the Paris Agreement. And this is a very truly stretching resolution. And again, it secured a decent level of support, generated a huge debate, and I think really is a good example of how investors are saying to companies through these tactics and through these engagement strategies, including resolutions, we really need to be confident that you've understood the climate risk to which you're subject, which is a risk for our entire portfolio, not just for you as an individual stock. And we need to see action now. So I think that's a very positive development. Let me move on to the final slide, which is just to highlight that engagement can encompass a number of different purposes and objectives for investors. So the classic form of engagement is a conversation or it might be a correspondence that helps investors to just get better insights about the companies in their portfolios. So these are just sort of almost information gathering engagements, helping to better understand through a conversation with management about their strategy, about their risk management, around also, and in governance, there'll be a lot of conversations that help to understand how a board might be thinking about board succession, or how it might be thinking about developing and designing its remuneration. So some of the engagement, a lot of the engagement taking place is around just extracting better information and insights. But engagement goes beyond that. So it's also about influencing companies around their management of ESG risks. So this would be engagement that's really driven by an objective that the investor has to see a company doing something different. So it definitely goes beyond just extracting information from the company. It's very purposeful. It's about getting a company to manage risks differently and to get real results. And then thirdly, and we're seeing more of this now, I think we're seeing engagements which are really driven by getting companies to be just better corporate citizens and to deliver engagements that provide social and environmental benefits alongside better ESG risk management. So, and I think with the rise of things like the Sustainable Development Goals and the whole sense of climate change as a financially material risk, but also one that has a huge impact on the lives and future of beneficiaries of pension schemes, I think some investors are becoming much more confident and comfortable about saying, yeah, we engage also to deliver impact. It's a sort of form of engagement-driven impact investing, if you like. So I really see that that is a trend, a very positive trend in my view, and is part of what we're seeing in terms of this evolution of corporate engagement. So I'm going to leave it there. I hope that's been some useful food for thought, and looking forward to the questions.
Thank you very much, Catherine. Catherine's written some really interesting pieces over the past few years. I would recommend you read them. I would now like to introduce Lisa. Lisa, are you there?
Yes, I am.
Fantastic.
Good afternoon, good morning. So, over the next few moments, I would like to talk about Impax's approach to engagement, and also about some of the observed trends, as well as some practical lessons learned to achieve more effective engagement outcomes, really across different ESG issues, not just climate or governance, etc., but generally speaking, ESG issues. So Impax Asset Management is a London-based and headquartered specialist manager focusing on companies and investments benefiting from a transition to a more sustainable economy through environmental and unconstrained global investments. We have a big focus on ESG and engagement across all our investments. And indeed, our proprietary ESG analysis at the company level is really the primary driver that gives rise to our active engagement. And we do those engagements both individually, but also increasingly with others, with investment partners, with other shareholders, and organizations such as, for example, Catherine's ShareAction. So looking at engagement at Impax a little bit more closely, why is it useful for us? Catherine mentioned the word purpose. What is the purpose for Impax to do engagement? So first of all, it is primarily about managing risks and monitoring our companies. It is about management and following up on management of the most material risks of our investee companies that we have identified, and to see how well companies are managing these most material risks through policies, processes, management systems, and in some cases, incentives. But we are also long-term investors, and it is absolutely in our interest to try to strengthen our investee companies over time and have them strengthen their governance structures, or whether it is, again, the material risk issues through proper processes. But thirdly, we are also very interested in seeing how companies respond to engagement. We think it is an important signal, and very interesting signal, regarding corporate attitude to long-term issues. Companies are very used to responding to short-term financial and operational questions, but how are they tackling and answering, and what is their attitude to these types of more long-term issues? And we look for companies that are wanting to continuously improve their processes and their structures, but also those that are listening to stakeholders and shareholders. And it is also interesting that academic research, I believe it is from London Business School, has shown that companies that responded promptly to shareholder ESG type engagements then went on to outperform a control group of companies, and this was a big sample meta study. So that's quite interesting about what we'd like to see from companies and their responses to our engagements. So the types of engagements that we do, about 2/3 of all of our engagements would be really sort of company-specific or bottom-up driven, which are really mainly stemming from our ESG analysis, but also from proxy voting, for instance. But also every year we established a small number of strategic engagement issues, and these might be driven by emerging issues that quite often come from legislation, policy, and regulation globally in different parts of the world. And then identifying the companies that have material exposures to these emerging risk issues and engaging with the companies on those issues. But also, what is our really sort of special area of engagement would be to focus on smaller companies that are perhaps not quite as evolved or not quite as far on the journey of developing robust sustainability processes and policies, etc., and who are frankly often quite confused because they get a lot of different types of questionnaires, questions, requests, etc., from stakeholders and shareholders. And we sort of offer ourselves as being a free, friendly consultant in trying to get them to focus on really robust, cost-effective sustainability processes and disclosures. So that's our sort of specific area of focus around engagement. Looking at the sort of engagement trends and some observations, but also lessons learned over the years from doing engagement, what sort of works well, what makes engagements more effective? Well, first of all, the sort of latest trends, it is fair to say that it is nowadays quite unusual to get very much pushback or negativity from companies around ESG issues. It is more about how should it be done. And it is also very fair to say that there are increasing amounts of collaborative engagements, and I would almost call it that there is sort of an engagement industry that is growing, which is very exciting, and that is absolutely what Catherine was talking about as well. And these types of engagements, together with, for instance, organizations such as ShareAction, they are very, very effective because they are being coordinated and driven by a expert organization, and then getting those shareholdings from the investors to back it up, as well as lead someone on some of the company meetings or discussions as well. So that is a very, very effective way of collaborating on engagements and to get positive outcomes, as Catherine was saying. In terms of regional observations that we have made, it is fair to say that Europe, sustainability issues and ESG, it is quite mature here. Of course, there's always areas that could be strengthened, but it is one area in particular where we feel might have been a little bit forgotten with in all the regulatory pushes even that we've seen in Europe on sustainability processes and disclosures, and that would be governance. So that is an area that we focus on quite closely in European companies. It is the governance structures. In Asia, we view a very interesting situation going on. So a few years ago, most Asian, at least smaller companies, would not have even sort of own IR departments, but this would be outsourced, and it would be quite difficult to get access to sort of company management teams to talk about engagement issues. This is changing very rapidly, and it is not least because of emerging regulations and policies and legislation in some Asian countries, for example, Taiwan, Thailand, and Hong Kong. And companies there are now setting up their first sustainability processes and disclosures, and they're really wanting to have feedback on how they're doing, what they should be doing next, etc. So we find it a very, very good moment, an interesting moment to do engagements with Asian companies. In terms of the US, I would say that US companies are increasingly open to these discussions. They very often acknowledge that they get many more questions around ESG processes and disclosures. And there is a improving attitude for sure. But we do feel that there quite often is a lack of sort of governance around these issues. Who is responsible? Who is accountable for these issues? Who is driving these sustainability processes to be done and robust? But it is also fair to say that in the US we see some of the best processes and some of the worst processes. So it is very, very different in the US. But we do definitely still see companies that report on sustainable practices through their charitable giving, which is a good thing, but that is not what investors are looking for in terms of robust processes to manage material risks. In terms of issues that we have observed is that there are some issues that are clearly being driven to the fore, and that would be climate and carbon, which is very important. But we would also caution that some issues might be slightly forgotten, such as water, which in some companies' cases might be absolutely more urgent and immediate as a risk to companies' operations and activities. So slightly, sometimes uneven focus areas, perhaps by investors. Finally, I wanted to talk about some practical lessons learned through our engagement work. I think it is very key every time we talk with the companies to understand where the company is coming from. What has the company done to date in terms of the sustainability processes and performance and disclosures? And are we engaging at the right level? We cannot talk about science-based targets to a company that doesn't even know what CDP is or hasn't even measured their carbon emissions, etc. What is the right level? Where should we start? It is also very important in our view to back up and argue for why some of our engagement recommendations make sense for the company. There are opportunities by doing these things, business opportunities, and we try to back it up as much as possible with academic and other type of research to make this more relevant and enticing for companies as well, so that it makes more sense. It is also quite a good discussion to talk about what is going on elsewhere in the world. For example, in terms of policies or legal changes, almost talking about sort of global best practices to get companies that are often very global to get them to see outside of their local markets and see what is the emerging global best practice, whether it is around governance or sustainability processes. I also think it is very important always in engagements to be very positive, collaborative, not criticize, and always be very encouraging about the steps that have been taken by companies. We also find it very useful to talk about frameworks of sustainability processes. For example, materiality and the Sustainable Accounting Standards Board is a good example. I think one of the areas of real confusion for companies is that they get so many different requests and questions by stakeholders and shareholders. One day it is about carbon, the next day is about animal welfare, and perhaps the following day about governance. So it is helpful to talk about, this is the direction of travel for sustainability processes and reporting. These are the types of standards and frameworks that are emerging, and we would suggest you think about those and follow those. And what is also helpful is to talk about peer companies. What are your peers doing? Which peer companies are doing this really well and why? And this is often a point that companies are very, very interested in hearing. One of the last things I wanted to mention was an observation that we have done is that we sort of call the positive feedback loop. And that is that quite often we send an email or a letter to the investor relations person at a company. And we start discussing a certain area of engagement or improvement that the company might do. When we then have a company meeting with the CEO, the CFO, as well as the IR person in the room, we take up this question again. And it has been mentioned, and the CEO or the CFO then often say, as the IR, so what has been done with this issue to date, etc. And we have noticed many times that this is sort of a good way of escalating an issue and things start to happen. But finally, it is really about process. We use calendar reminders to get back to our companies and ask, where did you get on this particular issue? And there's definitely, it's important to stay very patient and long-term in the thinking of engagement. But very important to follow sort of processes and remember to follow up with companies on these issues. I'm going to stop there and would be very happy to take any questions later on. Thank you.
Thank you very much, Lisa. Very, very interesting. We're now going to open up the panel to questions. I think this has been a very interesting conversation. So, sorry, I think we've got some. I think one of the first questions that I'd like to ask would be to Adam, and somebody's asking, so could you please comment on the way in which you've sought to your fixed income managers to engage constructively with corporate management in terms of mitigating financial risks related to ESG factors?
Hi. So one of the key things for us is that obviously we engage ourselves. We have our own ethical policies. We're an ethical investor. This sets out the way that the statutory national investing bodies, which includes the commissioners, the pensions board, sets out our sort of priorities. But we also have an expectation that our managers are also engaging on our behalf. And increasingly, my role, I've just started a new role as Director of Engagement Ethics at the board. The pensions board is to sort of ensure further integration across all of our managers in the way that they're engaging, but also in the way that they're reporting to us in terms of issues such as climate change. And if I'm taking that case in point again, we would have an expectation that they would be reporting to us against the tool that we would be using, which is such as TPI. But we would also have. We will be assessing the work of managers on these issues for us and have a set of expectations and criteria that we'll be evaluating them against.
Lisa, would you like to add something to that? Hello? I think we might have lost Lisa. We'll try and reconnect.
No, I'm
sorry.
I'm still here. Sorry.
Oh, okay. Sorry. Would you like to add to that? So
we are really sorry. Yeah, go ahead.
Yeah, sorry. I was just going to say, would you like to add to what Adam says on fixed income managers and engagement?
So we are really focused on equities, so not really our focus area of fixed income.
Mustafa?
Yes.
It's Catherine here. I'd very much like to add to it.
Yes, of course.
If I may.
Yes, please.
Just because I think it's such an excellent question, because all of this engagement activity has been very, very focused on equity investors. And obviously equity investors do have voting rights, which are a very, very valuable engagement tool, because it's a really helpful way of sending a signal to companies. But I think fixed income engagement strategies are about to really take off. And I think if you look at the PRI signatories and all of the all of the asset owners, they all, of course, are bondholders as well as equity holders. And it's becoming very clear that, for example, in respect of climate-related risk, it could make a huge amount of sense for investors to have a coordinated approach of engaging using both their bond holding and their equity holding, which are often in the same companies. After all, they're equity holders in companies who are also issuing bonds, and same investors hold both the equities and bonds of the same corporate entities. So I think we're going to see, and we're just beginning a project on it at ShareAction with Wolfgang Kuhn, who was very recently head of Pan-European fixed income at Aberdeen Asset Management. we're doing a sort of a mini research project, and we're very interested in anyone on the line that would like to kind of hear about it or participate in it. But to just explore the extent to which both asset managers and asset owners would be willing to say to companies that really do not have a credible transition plan in the face of the low carbon transition, but are high carbon companies fully exposed to the risks, that they would signal, we won't in future roll over your bonds, we won't repurchase your bonds, and when you issue them, we won't be in the line to buy them if we do not see credible low carbon transition plans from you. So I think we're actually about to enter an era where we see some really smart joined up thinking between equity engagement strategies and bond engagement strategies.
Thanks, Catherine.
I wouldn't disagree with that at all. I think she's quite right.
Thanks, Adam. I think recently I also read a recent report by the PRI. They came out with ESG engagement for fixed income investors, managing risk and enhancing returns. And they also included a few examples of what people are doing at the moment. So I would recommend having a look at that. So, Catherine, we have a question for you. Are disclosure initiatives only limited to public companies at this point? And what about private companies?
Hi. So, no, they're not. So we just talked about bonds, but also private equity. I think actually there's actually been a long tradition of good engagement practice in the private equity space because typically the holdings are larger for private equity owners, and general partners have often had a lot of dialogue, and some of the big kind of private equity houses out there have some pretty sophisticated ESG strategies and engagement strategies. They just don't get as much kind of coverage and media profile because being private companies, it's much more of a private conversation, and they don't have AGMs where anyone can buy a share and turn up, and where the media turn up as well. But I think these strategies are alive and well in the private equity space. I think they're alive and well in other asset classes as well, like property. I think historically good stewardship of property assets has always involved a good dialogue between the owners and the management of the property assets. So yeah, I think these are highly applicable strategies in other asset classes, but equities are just the one that gets the most airtime and coverage.
Thanks, Catherine. So another question, this was directed at Lisa, but everyone feel free to chip in. So the question is, the very largest fund managers in the world seem to have conflicts within their business models that mean they often don't vote in interest of long-term shareholders. How have you seen signs of this changing?
So I think this is a reflection as well of a evolving focus on ESG, and I think for many fund managers for whom this approach is quite new, it does take time to get all the processes to go through in terms of policies and be aligned with policies and processes in terms of voting as well. I do think this is going to happen over time. I think there is a lot of scrutiny of how companies and large asset managers are voting. So I do think that is going to be changing quite quickly.
Thank you. And a lot of people are also asking, how are you defining smaller companies?
Yeah, no, that's an excellent question. It doesn't necessarily always have to be smaller companies that we focus on in terms of our engagement, but in many cases there are smaller companies, and I would say they would be, have a market cap of less than perhaps 5 billion, or in some instances maybe $10 billion. But the point really being is that these companies that we focus on for engagement around creating the first steps of robust and cost-effective sustainability processes and disclosures, that they're just very early on that journey. And yes, they tend to be smaller, less than 10 billion market cap companies, but in some instances they are larger. And it is a reflection to some extent as well on, have these companies had these questions in the past from shareholders, and when these questions accumulate in terms of engagement, things start to happen as well. But at the same time, there has been this evolving and emerging confusion that companies are often expressing. What should we be doing? We get so many different types of requests and questions, and that's, I think, really want to tackle and focus on very material issues as a starting point.
Thanks, Lisa. And we'll have one last question. Does engaging with oil and gas companies on T2C compliance give the impression that they're actually doing something when they have a long track record of doing nothing of consequence? And is this free PR actually worse than doing no engagement and managing climate risk in other ways? I will start with Adam.
I mean, I think we're I said at the beginning, I think we're at an absolute key moment where up until now you've had largely the oil and gas sector saying, yes, we can do emission reductions for those emissions directly in our control, Scope 1, Scope 2, which is about 20% of their impact, give or take. Actually, now you've got two major oil and gas companies have actually acknowledged that, no, they have a responsibility that means that they're going to seek to move their business model away from oil, move to gas, etc., and change the way that they're actually profiled as a company to become a primary energy producer. So I think we're at a really significant moment where I think you are seeing the first moves of companies breaking ranks with the consensus that previously existed in the oil and gas sector. I don't think all oil and gas companies are going to manage the transition. It's quite clear if you look at a scenario now and a scenario of 2 degrees in 2050, there is oil, there is coal, there is gas, there's just a lot less of it. So that means that some of these companies will be able to manage that transition and some won't. And for me, I think it's absolutely right to engage with the whole sector. I think it's incumbent upon asset owners at the top of the investment chain to be clear in terms of their expectations. I feel moving the debate from disclosure onto performance, which is what's really happened over the past sort of 6-8 months, I think, in particular in relation to Shell. But now there's a real clear understanding that actually we need targets that are aligned to Paris, and we need to then start using the tools that we have available to us to be able to encourage the company to move down that path. So I think you'll see significant moves. I think you're already beginning to see it. I don't think people have fully understood the implications of what's happened with the sort of announcement that Shell came out with and the moves that Total have made. But I think over the coming months, this will become more and more apparent that we are on the cusp of change. I don't think you'll see all of these companies transition, and I think different strategies will be perfectly viable. Some companies will just sort of roll out their existing assets and that's it, and pay back to shareholders, and I think that's a legitimate strategy if they're being clear about that to their base. But ultimately, we know that there's less oil, we know that there's less coal for mining companies. We just need to know which companies are best placed to manage that transition and which ones we're going to have to push very hard, and equally those that pose the greatest risk. I mean, those are the ones that I think you would hope that the market will begin to price appropriately.
Thanks, Adam. I'm very aware of the time. I think as closing remarks, I think if we could go over the panel with one sort of last comment, what would you say are the biggest lessons you've learned as an evolution to ESG corporate engagement? We'll start with Adam and then Catherine and Lisa.
I think the key one is to not underestimate the ability to influence that asset owners have, and to ensure that you've got the right tools to determine what it is you're asking for.
Catherine?
Shall I say speak up?
Yes, we can hear you.
Okay. It's very hard to pick one final thought, but I just think that the biggest investors in the world are all investing someone else's money. Their pension funds, their insurance companies, their asset management organizations. They're investing other people's money. And I think what's really changed and shifted, and will continue to change and shift in a very positive way, is that there is now very clear expectation that in order to be effective as an investment organization looking after someone else's money, you need to be really committed and putting proper resources into engagement with companies in all different asset classes, and this is now part of what good investment looks like, and that's a very positive thing, because companies need engaged and active owners if they're going to achieve their long-term potential. It's all part of kind of getting the right kind of capitalism, and it's great to see it happening.
And last but not least, Lisa.
Thank you. Yes, I would say that one should really, as an investor, as a shareholder, underestimate the ability of investors to achieve and get to positive outcomes through a positive but patient engagement program, which is well backed up by evidence for the companies. Why does this make sense to me? Why does it make sense to do these structures or processes? And we do see positive outcomes, but they tend to take time. So patience is required.
Thank you very much, Lisa. That concludes our webinar, Evolution of Corporate ESG Engagement Strategy. Thank you very much, Adam, Catherine and Lisa. Thank you to all the attendees. We will send you a link with the recording, and as promised, the discount code for webinar participants for the Sustainable Investment Forum North America is webinar 26. We hope to see you in New York in September. Thank you very much again. Thanks.